While the world focused on a vertical rally in precious metal screens, the real event happened inside clearing systems and vault-linked ledgers in Shanghai. What collapsed was not silver's price. It was the illusion that paper exposure could expand indefinitely without consequence. On the surface, China HS-only pure play silver fund surged, limit up day after day, celebrated as proof of global demand and financial momentum. Beneath it, a widening fault line formed between paper claims and physical metal. Premiums detached from reality. Arbitrage mechanisms failed quietly. Liquidity thinned where it was assumed to be deepest. Warnings were issued. They were ignored. Rules were tightened. Too late. This was not a market correction. It was a stress signal. The sudden 10% plunge did not end a bull run. It revealed a system operating beyond tolerance, where margin rules, subscription caps, and trading halts became tools of containment rather than governance. This story is not about silver enthusiasm. It is about how modern financial systems absorb speculative pressure until they cannot, and how physical constraints reassert themselves inside a structure built on leverage, velocity, and confidence. What the public saw was a surge. Silver on screens accelerated upward. Funds hit limit-up days in sequence. Headlines framed it as demand, momentum, and renewed faith in hard assets. What actually broke was discipline. Prices rose faster than liquidity could support. Premiums detached from underlying value. A narrow set of instruments absorbed a disproportionate volume of capital, turning a market into a funnel. The rally appeared broad, but participation was thin. It was concentrated, leveraged, and fragile. On the surface, nothing failed. Trading continued. Volumes printed. Gains compounded. Beneath it, the system stopped clearing risk efficiently. This was not price discovery, it was pressure accumulation. The causal chain was mechanical. That attracted B. Rising prices attracted short-term capital. That capital sought speed, not metal. It entered through paper instruments designed for liquidity, not delivery. B distorted C. As inflows accelerated, arbitrage incentives should have corrected mispricing. Instead, they stalled. Position limits, balance sheet constraints, and rising margin requirements reduced arbitrage participation. The correcting force weakened. With arbitrage impaired, liquidity thinned asymmetrically. Buy-side depth expanded. Sell-side depth vanished. The market became a one-way queue. D exposed institutions. Funds, brokers, and clearing members carried expanding exposure without corresponding physical coverage. Margin requirements rose, not because of volatility, but because of imbalance. The analogy is a vacuum. Capital rushed in faster than risk could exit. Pressure built silently until structure, not sentiment, became the limiting factor. The first response was invisible. Margin requirements increased, quietly. This raised the cost of maintaining positions without signaling distress. Next came behavioral constraints. Liquidity providers reduced size. Volatility controls tightened. Screens still showed green, but depth disappeared. Then came structural intervention. Trading limits were approached repeatedly. These are not safeguards of price. They are safeguards of the system. History rhymes here. In 1980, silver rules changed when leverage overwhelmed order. In 2008, liquidity vanished before prices collapsed. In 2022, nickel trading halted when paper obligations exceeded tolerance. Each step increases stress because each removes an exit. Markets don't fail from selling. They fail when selling becomes impossible. Away from screens, signals diverged. Dealer premiums widened instead of compressing. Delivery times lengthened, not shortened. Inventory classifications shifted, with metal remaining eligible, but not registered. Available in theory, unavailable in practice. Industrial demand did not surge. It stayed constant. This was not consumption pressure. It was financial velocity. The silence was the signal. When prices rise but metal does not move, the divergence has already begun. What the public saw was continuity. Prices held. Screens stayed green. Commentators described consolidation after strength. What actually happened was a failure behind the interface. The market stopped self-correcting. The divergence between paper instruments and their underlying reference widened without resistance. Premiums expanded instead of compressing. Volatility appeared controlled, but only because transactions stopped occurring where they were supposed to. This was the hidden event. Not a crash, not a spike, a quiet seizure inside the plumbing. From the outside, the system looked calm. Inside, it stopped transferring risk. The mechanism followed a predictable chain. It created an arbitrage signal. As fund prices detached from futures, arbitrage incentives increased. On paper, this should have drawn in capital to close the gap. Balance sheet constraints intervened. Traders faced higher margin requirements, tighter position limits, and rising funding costs. The trade was profitable in theory, unworkable in practice. With arbitrageurs sidelined, natural sellers disappeared. The order book became thin and directional. Liquidity did not vanish evenly. It retreated only from the side needed to restore balance. D concentrated exposure. Funds and intermediaries accumulated mispricing risk without relief. Clearing members absorbed growing stress as offsetting flows failed to materialize. The analogy is a bottleneck. Too much volume pushed toward a narrow exit that was no longer open. Pressure built upstream, unseen by those watching the final gate. This is how markets break without moving. The first escalation was structural silence. No announcements, no halts. Just fewer participants willing to intermediate risk. The second was internal repricing. Clearinghouses adjusted margin models. These adjustments are mathematical acknowledgments of instability, even when prices remain elevated. The third was behavioral withdrawal. Market makers reduced exposure. Arbitrage desks stepped back. Liquidity became conditional, then discretionary. History repeats quietly. In 2008, interbank spreads widened before equities fell. In 2022, the nickel market failed internally days before the halt. The visible event always lags the mechanical one. Each step increases stress because it shifts risk upward, from traders to brokers, from brokers to clearing systems, from clearing systems to rule makers. Physical indicators diverged further. Dealer quotes became indicative, not firm. Small orders cleared, large ones stalled. Inventory data showed stability on paper, but turnover slowed markedly. Registered supply did not increase. Eligible metal stayed idle. What the public saw was structure. Funds tracked benchmarks. Futures rolled smoothly. Settlement dates passed without incident. On the screen, silver exposure looked standardized and repeatable. What actually broke was the assumption of equivalence. Paper exposure multiplied while the underlying system stayed fixed. Contracts expanded. Shares increased. Claims stacked on top of the same finite pool of metal. Nothing failed visibly because nothing was forced to settle physically. Yet the gap widened between what was owned on paper and what could be delivered in reality. This was not fraud. It was design meeting scale. The chain here is mechanical and unavoidable. It begins with structure. Silver funds do not hold bars. They hold futures. Futures are promises to transact later, usually rolled forward before delivery. B introduces leverage. Each roll assumes liquidity. It assumes counterparties. It assumes margin stability. As participation grows, so does gross exposure, without adding metal. C creates margin pressure. When volatility increases or positioning crowds, clearinghouses raise margin requirements. This drains liquidity from participants, precisely when it is needed most. D transfers risk to institutions. Funds must post collateral. Brokers intermediate. Clearing members guarantee performance. Each layer assumes the next will function. The analogy is a queue. Everyone holds a ticket. Few intend to reach the counter. The system only works if no one asks what's behind the door. Paper claims expanded because they could. Physical metal did not. The first escalation was mathematical. Margin models adjusted. These are not opinions. They are responses to concentration and correlation. The second escalation was operational. Roll windows narrowed. Liquidity at the back months thinned. Costs rose for maintaining exposure. The third escalation was discretionary risk management. Institutions reduced tolerance. Limits tightened. Participation became conditional. This is familiar. In 1980, silver futures rules changed when leverage overwhelmed delivery logic. In 2008, collateral calls cascaded through instruments assumed to be liquid. In 2022, the nickel market demonstrated what happens when paper obligations exceed physical tolerance. Each step compresses time. What was once a gradual adjustment becomes a forced response. The physical layer remained unmoved. Vault reports showed metal present, but inactive. Registered stocks did not rise in response to price. Eligible metal stayed eligible, not committed. Premiums at dealers did not fall. They widened, quietly. Industrial buyers did not release inventory. They held it. These are not speculative behaviors. They are defensive ones. When paper volume grows without physical response, the system is signaling constraint. Not loudly, but unmistakably. What the public saw was caution. Statements were issued. Language softened. Risk disclosures were repeated. Access was framed as being managed. And what actually occurred was institutional alarm. Warnings from fund managers are not market commentary. They are internal signals made public because thresholds have already been breached. When administrators speak about unsustainable conditions, they are documenting exposure, not speculating about price. Nothing collapsed on screen, but confidence inside the system fractured. This is the phase where markets are no longer trusted to regulate themselves. The mechanism followed a familiar progression. It began with concentration. As inflows accelerated, exposure pooled into a narrow structure. The fund grew faster than the futures market beneath it could absorb risk. B triggered internal stress tests. Institutions modeled reversals. In those scenarios, arbitrage did not restore balance. Liquidity vanished. Margin calls cascaded. C forced margin pressure. Clearing members demanded more collateral. Funds faced higher cash requirements without the ability to reduce exposure efficiently. De-escalated institutional exposure. Brokers, custodians, and clearing systems became the shock absorbers. Risk that was once distributed became centralized. The analogy is a pressure valve. When internal pressure exceeds tolerance, release is controlled or enforced. This is where panic hides, not in selling, in administration. The first escalation was communication. Warnings replaced promotion. This shift alone signals a regime change. The second was procedural tightening. Risk limits were revisited. Internal committees intervened. Trades that were acceptable days earlier required review. The third escalation approached structural control. Access restrictions, subscription limits, and conditional participation emerged as tools of containment. History is consistent. In 2008, banks spoke of orderly markets days before liquidity froze. In 2022, the nickel halt was preceded by internal alarm at clearinghouses, not by public volatility. Each step increases stress because it replaces market pricing with discretion. Discretion reduces transparency. Reduced transparency accelerates withdrawal. Physical indicators did not confirm relief. Dealer inventories were quoted with conditions. Large volume orders required negotiation. Settlement windows widened. Vault movements remained minimal. Metal stayed put. Industrial participants reported no easing. Supply chains did not respond to higher prices with availability. The screen suggested abundance. Institutions behaved as if scarcity was imminent. What the public saw was protection. Subscription caps were lowered. Participation rules were adjusted. Language emphasized stability and investor safety. What actually broke was symmetry. Markets function on the assumption that entry and exit are governed by the same rules. When that symmetry disappears, price becomes administrative rather than discovered. The rally did not end naturally. It was compressed. These changes were not reactions to volatility. They were reactions to stress already embedded in the system. The causal chain was explicit. It began with imbalance. Inflows continued to pressure a structure that could not expand its physical or hedging base proportionally. B neutralized arbitrage further. By restricting subscriptions and access, the ability to correct premiums through new positioning was removed. The theoretical arbitrage incentive remained. The practical execution vanished. See intensified liquidity removal. With fewer participants allowed in and existing holders constrained, liquidity became episodic. Depth appeared, then disappeared. D transferred risk inward. Existing investors absorbed the full volatility of adjustment. Institutions contained exposure by narrowing participation rather than reducing claims. The analogy is a narrowing gate. Pressure does not dissipate. It concentrates. Rule changes do not eliminate risk. They relocate it. The first step was access control. Limits on subscriptions, position sizes, and participation thresholds. The second was behavioral distortion. Trapped capital changes behavior. Holders rushed to exits simultaneously when windows open. The third step approached contingency planning. When rule changes fail to restore balance, exchanges and administrators prepare extraordinary measures, delayed settlement, forced cash conversion, or contractual discretion. History is precise here. In 1980, rule changes accelerated the silver collapse. In 2008, withdrawal gates preceded systemic freeze. In 2022, trading halts replaced price formation entirely. Each step increases stress because it signals that the system is defending itself. Systems defend themselves only when limits are reached. Physical signals hardened. Dealer premiums became non-negotiable. Availability shrank despite higher prices. Delivery commitments were shortened or conditional. Inventory classifications did not change materially. Registered stocks remained static. Eligible metal stayed uncommitted. Industrial buyers did not respond with supply. They secured it. These are not speculative reactions. They are preservation behaviors. Rule changes mark the final transition from market-driven imbalance to administratively managed strain. What the public saw was resilience. Prices held. Futures extended gains. Official systems remained open. No default was announced. What actually surfaced was the boundary. Every paper market eventually encounters the same limit: delivery. When price signals fail to mobilize supply, the system is no longer pricing abundance. It is rationing scarcity. Nothing dramatic happened on the screen. But the absence of movement in the physical layer became definitive. This is where narratives end and mechanics take over. The chain here has no optional steps. It begins with accumulated paper claims. Years of rolling futures and fund inflows created exposure multiples larger than deliverable metal. B confronts physical reality. Only a fraction of contracts can be satisfied with bars. The rest rely on confidence that delivery will not be requested simultaneously. C triggers contingency planning. As stress rises, exchanges and clearinghouses prepare for non-standard settlement. Margin is raised not to prevent volatility, but to deter delivery. D exposes default pathways. If claims exceed tolerance, systems invoke discretion, delayed delivery, cash settlement, or force majeure clauses. The analogy is a dock with one ship. Tickets were sold freely. The tide has changed. At this stage, outcomes are no longer negotiated, they are enforced. The first escalation is deterrence, higher margin, longer delivery timelines, administrative friction. The second is conversion. Cash settlement replaces metal. This preserves continuity while admitting constraint. The final escalation is suspension. Delivery obligations are redefined. Contracts survive. Trust does not. History offers no exceptions. In 2008, physical demand exposed paper leverage. In 2022, nickel contracts were voided to preserve the system. Each step increases stress because it confirms what prices deny. Metal is finite. Claims are not. The signals are now unambiguous. Dealer inventories are quoted sparingly. Premiums detach completely from futures. Delivery windows extend beyond contract logic. Vault reports show stability without movement. Metal exists. It does not circulate. Industrial users secure supply off-market for certainty. This is the final stage of divergence. The screen continues to update.